There are two main strategies when it comes to investing. One is called lump sum investing and the second one is called dollar cost averaging. So in this video we will talk about both. We will discuss what both of these strategies are, when it is better to use one or the other, advantages and disadvantages of each strategy, and at the end of the video I will also tell you which strategy I chose for my own investing and why. So if you want to know the answers to these questions, then please keep watching this video. Hello guys and welcome back to my channel. My name is Anastasia. On this channel I talk about investing and especially investing for beginners. Only last week I made a video about my results on Vanguard UK. If you haven't seen this video, you can watch it if you click on this link here. On Vanguard I used the strategy of dollar cost averaging, but in this video I've also said that it is quite tempting to just put a lump sum of money and sort of forget about it. So it took me some time to learn about these strategies, to read about them and understand the disadvantages and advantages of each one to be able to choose the best strategy for myself. I hope that this video will help you to understand the differences and it will make it easier for you to choose between the two strategies. I also hope that this video will help you save time. You will not have to spend hours and hours reading about it just like I did. So let's start with dollar cost averaging strategy. I think it is quite easy to understand what this strategy is about just by its name. What you have to do when you use this strategy is not put a lot of money into a certain investment straight away, but instead you divide the sum that you have allocated for investing and you invest little by little with a certain frequency. For example, you can invest every month or you can invest every week, every Monday, even every day. It depends on you. The main idea of this strategy is that you shouldn't pay a lot of attention, or really you should pay no attention whatsoever at the price of the asset at the time when you're buying it. You are not trying to catch the lower price here. All you do is just regularly invest with the hope that by the time you need to withdraw this money, the sum will grow anyway. Lump sum investing is very different. With lump sum investing, you just take all the money that you have allocated for this investment and you invest this money straight away. But with lump sum investing, there are two ways of how you can use this strategy. You can take the whole sum and invest it into S&P 500 without really trying to catch the lowest price, and then you wait for 20-30 years, because most probably over such a long period of time this sum will grow anyway and your money will be working all this time. The second way of how you can use it is you can try to catch the lower price. So you can try to catch the crisis, the bottom of the crisis, and you invest this sum at that point. In this case, you might have to wait for some time, but if you are sure, or if you think that you know that the crisis is coming and is coming soon, this might be the strategy for you. So to understand what strategy is better or what strategy is worse, let's look at the advantages and disadvantages between the two. Among the main advantages of dollar cost averaging strategy, we can name the following. Well, first of all, by using the strategy you minimize the risk. According to the Vanguard research, if you use the lump sum strategy, then the average risk that you take on is 22%. So there is a 22% chance that you will end up losing money. In case of dollar cost averaging, this risk is coming down to 17%. So the difference is not that big, it's only 5% difference, and the risk is quite low in both case scenarios. But anyway, if risk is something that you pay a lot of attention at, then you should know that dollar cost averaging strategy reduces your risk. The second advantage of dollar cost averaging strategy is that it will help you to get into the habit of investing. If you are a beginner investor, then dollar cost averaging strategy might be better because you probably feel quite anxious about investing big sums straight away and do something that you've never done before. With dollar cost averaging, margin. You don't have to invest everything straight away. You can see at the beginning how it works, and if you can tolerate the risk and if you see the returns, then you might find it easier to invest bigger sums or the full sum. You don't have to stick to one strategy. If you see that your circumstances changed, then you also can change the strategy. I think it's only wise. Lump sum strategy also has some advantages. The first and the biggest advantage is that all of your money starts working straight away. Say you invested all of your money into S&P 500, and if we take the historical return on investment from S&P 500, it is on average 7% per year. So next year you will get 7% of $10,000, which of course is more than if you invest a dollar cost averaging strategy, because then your return on investment will be calculated differently and it will be less. The next advantage is that with lump sum strategy you can invest everything from the very beginning and forget about it. This is an advantage for those investors who are looking for passive investing. A lot of people like following the returns and they will probably find this way of investing quite boring. But with the dollar cost averaging strategy, you constantly have to remember to buy more funds or to buy more assets. You have to be more organized. You have to put maybe an alarm or some sort of reminder on your phone that, for example, every Monday or every first day of the month, you have to buy more shares of whatever asset you invest in. And sometimes you may forget, sometimes you were too busy or too tired doing other things, so you don't end up doing it. You skip a week or you skip a month. This is when it becomes a problem. The last advantage of lump sum investing was again proved by the Vanguard research that said that 2/3 of the time lump sum investing will show better results than dollar cost averaging strategy. Vanguard has based its research on the historical graphs and the historical performance of S&P 500, and according to this performance, if you invest a lump sum of money, not trying to guess the lowest price, but just invest it at any point, not even looking at the price that you are buying your shares at, still 2/3 of the time you will end up making more money than if you were investing little by little using the dollar cost averaging strategy. So now let's look at some examples. If you invested $10,000 in March 2009 during the financial crisis, in October 2020 you would get more than $51,000 back. This is a great return, but the problem of this whole theory is that it is based only on a hindsight. How could you really guess that in March it was the best time to start investing? You probably couldn't. But say you did, you guessed it, or you knew it, or you were lucky, then your return on investment would be great. Let's take another example, the more recent one, with the crash that happened in 2020 because of the coronavirus pandemic. If you had $50,000 to invest in January 2020, it would buy you 150 shares of S&P 500. But already in March, when the crash happened, the same $50,000 would already buy you 218 shares. So your return on investment would be much better if you invested the lump sum in March. But again, the question is, how did you know that the crash was coming in March? And the bigger question is, how would you know that after the crash in March, the market would recover as quick as it did? In fact, it took only 58 days and the price of S&P 500 has increased by 37%. No one was expecting it, even the best experts of the market, because by looking at the history and the historical graphs that we know, it takes much longer for the market to recover. So investors weren't in a hurry to buy more shares of S&P 500 because the majority was expecting a bigger crash, when everything has turned completely within less than 2 months. And since then, S&P 500 keeps on growing and beats the all-time highs almost every week, which shows that the historical graphs is not something that you can rely on all the time. So unless you were lucky and you invested a lot of money in March, you would probably end up losing some money. So in such unstable conditions of the market, the dollar cost averaging strategy is the way to go, because if you were investing little by little during these very unstable months, you would be able to buy about 173 shares. It's more than 150 that you would get if you invested in January. But if we judge these two strategies by the historical historical graphs, we see that on average we have the bull market for 60% of the time and the bear market for 40% of the time. And on top of that, during the bull market, the average growth is 415% compared to the average loss during the bear market of 65%. So this is the main reason of why using the lump sum strategy and investing it at any point in time, if you have the long-term investing goals, you are more likely to make more money than if you use the dollar cost averaging strategy. But there was a moment in the history which shows us that these statistics don't work all the time. If you invested $10,000 in 2030, you would have to wait for 20 years to get your money back. So you see, it's always different, and the truth is, no one can predict the market, no one can tell you, no one can guarantee you where the market will move next. So for myself, I chose the dollar cost averaging strategy for the next reasons. First of all, at the moment the market is almost at all-time high. I mean, the S&P 500 is at all-time high, and the market conditions are very unstable. In these conditions, I think the next crisis is quite likely. I'm not one of those people who predicts the crisis in the nearest future, but I think the chances are quite high. The second reason is that the mental and the psychological aspect of invest in a lump sum, I think, is undervalued. I know by myself that if I invest a lot of money in one go and then I see it going down for a long time, I will be stressed. And I think that my stress is just not worth it. I consider myself a well-organized person. As a rule, I don't forget to invest regularly. Only sometimes, maybe. So using a dollar cost averaging strategy is not a problem for me, especially when it shows good results, and so I don't see much point in changing the strategy anytime soon. But I'm also open to the new situations and new conditions of the market, and if I decide to change my strategy at some point, I will definitely do it. Information in this situation is the key. Now I hope that you have enough to make your own decision, so thank you guys for watching this video today, for taking your time. I hope you enjoyed it, and I also hope to see you soon. Bye bye!